Well, welcome everyone to our webinar today. As always, we've got a great one for you. Excited to get started. I do appreciate everyone submitting your questions ahead of time. Definitely helps us with the content. And as we go throughout today's show, please, use the chat feature and submit any additional questions that come up as we go through it. And we'll do our best to answer those at the end of the webinar, or as always, we typically will record even a podcast and address those questions afterwards. Well, my name is Matt Wilson. I am the Chief Investment Officer and President here at Keen Wealth Advisors. And Keen Wealth Advisors, we're a fiduciary financial planning and wealth management firm headquartered here in Overland Park, Kansas. And, we hold these educational webinars typically every month. And, we've got a lot of clients on this webinar, but also folks that aren't clients. And, hopefully you learned something. I know for the clients that are on today's call, our planning team, they definitely will talk to you about these items as they arise. But these things are things that happen from time to time when when you have an unexpected retirement. Today's topic. But a little bit more about us. You can find our retirement resources on our website, keenwealthadvisors.com. Scroll down to the retirement resources page, and then you'll see a listing for the blog, podcast, and our previous webinar replays. You can go back and peruse any of the podcast episodes or any of the previous webinars that we have hosted. Also, Mr. Keen, he is a author of a Amazon best-selling book, Keen on Retirement: Engineering the Second Half of Your Life. I know many of you have a copy of that, but if you don't or would like us to send a copy of this book to a friend, family member, whoever, let us know. Send us an email, reply to any of the emails that you receive from us, or send me one directly, mwilson@keenwealthadvisors.com, and I'll make sure we get a copy of the book out to you or whoever you'd like us to send it to. And then we were recently recognized by USA Today as one of the best financial firms in the country, and excited to share that with everyone. It was a nice recognition when we got that email that we were being awarded with this for 2025. And then also check out our YouTube channel. We post all of our webinar replays, but also the video version of our podcast and additional videos that you can't find anywhere else will be on our YouTube page, youtube.com/Keen Wealth Advisors. So let's get started. Today's topic: are you being forced to retire early for any reason? And the reason we're talking about this is because it does happen. There's a significant number of workers who find themselves in this situation. And, I titled it "Forced into Retirement Early for Any Reason." There can be a lot of different reasons, and we'll kind of talk through what those are. But I wouldn't say someone's forced into this, but sometimes people retire early because they choose to. That's also a viable option, and an option a lot of people take. Especially when they sit down with us or sit down with someone who does comprehensive retirement and financial planning for those that are at or near retirement, and you go through what you're looking to accomplish in retirement. And many people realize they can retire sooner than they thought. Even with expensive healthcare and the unknowns around Social Security choices and how the investments are going to perform. We walk you through all of that and how that works for you and what the strategies are to accomplish retirement on your terms. But let's say you are forced into retirement early, whether it's a health reason or your employer makes a decision that's just out of your control. And now you're faced with with this situation. So we'll talk about, how does health insurance work? What about Social Security? If you have access to a pension, if you have any debt, how should you think about that? What investment decisions will you be faced with? And how to think about your spending and tax planning as you go through this process. But the very first thing when when you're faced with this situation is just get aware of your financial situation. So I say start with your net worth statement. List out all of your assets and all of your liabilities. Just a lot of those can be retirement accounts, investment accounts, but you might have rental properties. Maybe you have some farmland. There could be a lot of different assets listed. Your home is an asset. And then what income sources do you have? Do any of those investments generate taxable income currently? That would be just a good idea to know. Okay, I've got that. When does Social Security start? What are those Social Security amounts at various ages? And then what kind of expenses are you going to be faced with on especially in the short run, so immediate kind of expenses, but then what recurring expenses do you have? Because it's really important to get an idea of where the money is going, and then listing out those expenses that you have and determining, okay, which ones are I have to cover these. I have to pay my mortgage. I have to pay my utilities. I have to pay for health insurance. I have just your basic costs related to running your household. But then also, just, I'm not saying cancel anything, but just know, well, which ones are discretionary. I don't have to have this expense if if it's something that could be removed. Doesn't mean that it's going to, but just knowing that that's an option should that be necessary. And then what expenses could go up, especially when you're faced in forced into this early retirement. The main one here is typically health insurance. If your employer was covering a portion of your health insurance and then you transition over onto COBRA, then you're going to have to cover the entire cost of that. So that would be an expense that would increase in retirement versus what you were paying while you were working. So let's talk about health insurance. So as I mentioned, you have access to COBRA. So the law says that you have the ability to maintain your previous employer's health insurance for 18 months. Some employers allow you to maintain COBRA for longer periods. It's what we call that extended COBRA. It's not available to everyone. That's up to each employer, and depending on the situation, if there was a severance as part of this forced retirement, maybe there's additional benefits related to that. But this is COBRA for 18 months is the law. If your spouse is working, then it's possible that it would make sense for you to join their health insurance plan if they have one, and if it's reasonable enough for you to do so. Anytime if you're married and your spouse partner is it retires or separates from service or forced into retirement, however you want to define that, that is a qualifying event, and that would allow you to hop on to a spouse's plan at that time. So it can be outside of the enrollment period. Another choice would be utilizing the healthcare exchanges, and I've got some examples here on how those work, because that's been definitely a viable tool and a resource for a lot of folks, especially if they're looking for health insurance prior to Medicare. Because at Medicare, at age 65, you're eligible for Medicare. If you're working, you don't necessarily have to sign up for Medicare, but if you're not working, that's the most common decision for people to make, is to begin Medicare at age 65. and begin that process. So let's talk through a healthcare subsidy example, because so healthcare.gov, the exchanges, anyone can go there. You don't necessarily have to put in your personal information. You can get quotes from from the various carriers that are on the exchanges by just entering in some general information, birth dates, any dependents that you have, kind of health status. They'll ask some basic questions, and you can get an idea of what the premiums and deductibles will be, because they have various plans. They have a bronze, silver, gold, and typically it's just how much. The difference is how much do you pay monthly and reduce that deductible versus paying less monthly and having a higher deductible. That's really the primary difference between the three, is that cost structure. For this couple, they're both age 62, and one spouse was already retired. The other spouse was working, and they were recently let go from their employer. And the COBRA for them, for just those the two people, was almost $23,000. And a little bit about them: they have retirement accounts of about $1.5 million, and those are in 401k. It says IRA here, but it's the big thing is to understand that's tax deferred money that they've put in pre-tax, includes company matches and all of that. And when distributions come out of those accounts, it's taxed as ordinary income. They also have a Roth IRA with $150,000 in it. And the big difference between those two types of retirement accounts is the Roth IRA, you pay the tax when you put the money in. It's a after-tax contribution. And the benefit is it grows tax-free. So distributions from Roth IRAs are tax-free. They have a joint account with $300,000 in it, and that could also be it could be titled in a trust if they had gone through the estate planning process and set up a trust. But it's what we would define or call a taxable account. So it's money after taxes, they've saved. And it could be at a bank, just in cash or money market or CDs. That's one option. You could also invest some of that money in a brokerage account, and the way the taxes work on that is you pay tax as you go. So any dividends, interest that's earned on those accounts are taxed. If you realize any capital gains, so if you sell an investment that's in that account that was up in value, that would be a capital gain, and those are taxed, just slightly different than ordinary income. And then they also have Social Security that they could turn on currently. The combined amount for both of them, since they're both 62, would be almost $48,000 from Social Security. And what they need is $120,000 per year after taxes. That's the key point. So this is, $10,000 a month spendable dollars is what they're looking for in retirement. Well, if they were to take all of the funds out of their IRA, they would approximately need to take $140,000 out of the account to clear. They would pay the federal and state tax among those distributions, and they would clear $120,000 after taxes. If when you look at the health insurance, so COBRA is almost $23,000. If you go to the exchanges, one of the things that they'll do on the exchanges ask you how much your income, how much income do you expect to have in the current year? And it's not quite just your gross income or your taxable income. It's modified slightly, and they walk you through it. But basically, you add back, if you're claiming Social Security, any of the non-taxed portion of Social Security. Check out our Social Security webinar. Everyone gets a percentage of their Social Security tax-free. It's a sliding scale based on how much income you have. But you look at your adjusted gross income, which if you look at your 1040, that's the bottom of page 1 is typically where you'll find adjusted gross income, and then you have some of these add backs. When you look at this couple and what they would take out, gross from their IRA, they're not going to turn on Social Security, so they're just going to take the distribution. If they were to just take the distribution from the IRA, the subsidy or the premium plus the deductible on healthcare.gov would be $14,702. So slightly less than COBRA, but it's still, still a big portion. And the healthcare.gov on this, with there is some subsidies that they're eligible for, even with $140,000 of income, but still almost 12% of their expenses, which is that's a big portion. You look at your budget and you're like, man, that's a lot of money that I'm paying for health insurance. So how could we help them reduce that? Well, because the way the subsidies work on healthcare.gov is there's a the lower your income, the more subsidy you receive. But it's not better to have no income, because at a certain level, if your income's too low, the government says, well, you don't qualify for any subsidies, you should be on Medicaid. Well, Medicaid, this person wouldn't be eligible because they do look at your assets. Whereas the subsidies on the healthcare exchanges, all they care about is your income. And there's ways to receive distributions from their accounts without triggering a lot of income, so that you can maximize these subsidies. So for them, we did this analysis and discussed with them various scenarios, but decided and landed on, let's pull $30,000 gross from their IRA and convert it to their Roth IRA. So we're going to take a distribution out of the IRA and move it over to the Roth IRA. That's allowed once that's called a Roth conversion. So there's two ways to get money into a Roth IRA. There's what's called a Roth contribution, and contributions are while you're working. So when you have earned income, so that's income from W-2, when you receive a W-2, or self-employment income, when you have earned income, you can contribute to a Roth IRA. If you have access to a retirement plan, such as a 401k that has the Roth option, you can contribute via the Roth into that account. And those dollar amounts, vary based on what the current rules are for 401k contributions and also for Roth contributions. Sometimes you're not able to make a normal Roth contribution because your income's too high, but you might be able to put money into the Roth 401k. Again, if questions on that or want to review that, definitely reach out to us and we'll help you think through where's the best way to contribute money, for retirement based on your situation. But we're going to convert money. So that's the second way to get money into a Roth IRA. And that's when you pull out money out of the IRA, it's taxed as ordinary income, but then you immediately shift it over to the Roth IRA. That's a Roth conversion. And we do these for folks all the time, especially when we're doing our tax planning. We're looking at what's their current kind of tax situation, but also we get a sense of their lifetime tax situation. And no one knows exactly what the tax policy will be in the future, but we know what the current rules are, and we can run different scenarios based on taxes being higher, being lower, and come up with with an analysis that we can use to make decisions on should we convert money to a Roth IRA. For this couple, considering their income, because they're not working anymore, the working spouse forced into early retirement, so no income coming in. The other spouse is already retired. They're not claiming Social Security yet. They want to wait on that. So they have no taxable income. The $300,000 in their taxable account, it's mostly in cash and some CDs. So it generates a little bit of income, but not much. And based on how much gross income they have, they may not pay any taxes on this Roth conversion. I mean, just looking at it and knowing where the tax brackets are, they're going to be in almost a 0% tax situation, even with this $30,000 Roth conversion on their tax return. But they do have enough income, so they're not being told on the exchanges when they go through the calculator or when we walk them through this that they need to be on Medicaid. So we're generating enough income so they're eligible for the subsidies on the healthcare exchanges. Well, based on this analysis, okay, they can choose COBRA, almost $23,000, but now their premiums and deductibles, because of the subsidy, they're paying basically $3,000 a year, $2,800 a year for their health insurance, significantly less. And they're going to convert money to a Roth IRA, which is great. So they're getting in this tax-free bucket. Now the question is, okay, well, they need $120,000 a year to live on. Where are they going to pull that from? Well, they're going to pull it from the taxable account. They're going to take distributions out of that account because they've already paid taxes on it. So it's not taxed when you take it out of the account and use it to pay your bills. It's only taxed when it earns dividends, when it earns interest, or if you trigger a capital gain. If you've invested in something, it went up in value and you sold it, then that's when you pay the tax. So in this case, for this couple, they have $300,000 over there. That'll get them nearly 3 years of their income needs into to qualify, maximize those subsidies prior to Medicare starting at age 65. And we use the example of taking money out of the traditional IRA and converting it to a Roth IRA. And that, we might recommend in a future year, instead of converting that 30,000, let's just put it over into your taxable account, your joint account, and send that to you as part of your distributions. And that amount could be a little higher based on, again, how much money they need if expenses showed up. And it potentially would reduce the subsidy, but it's a sliding scale, wouldn't necessarily just, max, reduce the subsidy to zero. It would, depending on the amount of income and distribution they would need, reduce that subsidy just a little bit. Now let's go back to to the list of things that we're going to look at here. So we talked about health insurance, what the choices are there, and then what about income sources and how do you get distributions from your accounts? I talked about the taxable account, but should you turn on Social Security? What pension choices do you have if you have access to a pension? When you have an IRA or a 401k, how do you get money out of those accounts? And especially if you're younger and you're faced with this situation, younger than 59 and a half, that's the key age for penalty-free distributions from your retirement accounts. And it's part-time work an option? It could be. We have a lot of folks that ask us, what if I go get a job at a local store and it's low stress, but just a little bit of income, potentially have access to health insurance depending on how much I'm working, something to keep me busy, or even a part-time role at the current employer could be an option, or another employer in the same field. Let's talk about Social Security. So to be eligible for Social Security, you've got to be at least age 62, and this is the standard eligibility requirements for Social Security. There's some unique situations with disability and things like that where someone might be eligible sooner, surviving spouse, but this is the standard. Eligible at 62, and you must have 40 credits. Well, what's a credit? A credit is 1/4 of paying the payroll tax or the FICA tax. So when you're a W-2 employee, you pay for your Social Security via the payroll tax. And there's a portion of it. The largest portion is for Social Security, small portion for Medicare that comes out, and you pay half of it and your employer pays the other half to get to it's about 12.5%. That is the payroll tax that goes into Social Security and Medicare. So you have to have 40 credits or 40 quarters of that, which is, the equivalent of 10 years of paying into the system to just be eligible. But the calculation, and it's not overly complicated. You actually can find how they calculate it on SSA.gov, but they look at your 35 highest years of earnings. So if you worked for 40 years, they're going to just take your 35 highest years and use that to determine how much your benefit is. Now, let's say you only work 30 years or 20 years and you don't have 35 years of paying into the system. Well, they'll just fill that in with a 0 and run the calculation that way. The way the formula works, it's skewed to where it's not if you had double the income or double the years of earnings versus someone who only had half, you don't have double the Social Security benefit. The way the calculator works is the largest portion is based actually on lower amounts of income, and then as your income is higher for this calculation, they basically break your income into tranches and have a smaller delta applied to the larger amounts of income. And you're eligible at 62, as I mentioned, and you can delay it up to age 70. We talk through that with folks a lot because that's it's a big decision. When should I start Social Security? And every single month, once you become eligible at 62, every single month you wait, you do get a benefit for waiting. It increases typically 7 to 8% on an annual basis from age 62 to age 70. And we can show you the calculators and the amounts based on how much it is when you delay and versus claiming it early. A lot of different ways to think about it. If you do claim it before your full retirement age, so for most folks, currently working, your full retirement age is age 67. So if you claim it early, let's say you claim it at age 62, there are some restrictions that apply to that. So you can only earn so much money and claim Social Security prior to your full retirement age. So if you're still working and your income, if it's over roughly $24,000 and you're claiming Social Security, well then once you're over that, again, roughly $24,000 of income, you're going to be penalized $1 of Social Security for every $2 over that amount. So for example, let's say you're $10,000 over the $24,000 threshold, you would have to pay back when you file your tax return $5,000. $1, it's $1 for every $2 over. If you're not generating earned income, so if you're taking distributions from your retirement accounts, if you have some capital gains that you're taking, and that's triggering a tax. If you have rental income, farm income, as long as it's not earned income, that's fine. That does not count towards this. Your spouse's income does not count towards this. It's only your own personal income and earned income specifically that counts on that. And then also, if you do claim it early and you're married, your surviving spouse, if you were the higher earner, would have a reduced survivor's benefit based on when you claimed your benefit. So something to be aware of in that situation. Here's how, just a visual, just some basic kind of information on Social Security. So what this is someone with a $2,000 a month benefit at their full retirement age, which is age 67 for them. And what we're showing is the cumulative lifetime benefits. So that's the bold number in each column. So if they claimed at age 62 and they lived to age 70, that's how much they would have received. And you can kind of go down. So if the lifetime benefit age 70 depend on when they claim. So the later they claim, the lower the lifetime benefit had they deceased at age 70. Here now age 75. Now you start to see the benefits of waiting. So once you reach about age 80, that's about the break-even point. You can see the the highest cumulative lifetime benefit if they lived to age 80 would be starting at age 66, whereas their full retirement age is age 67. But you can see the difference there. I know it's kind of covered up a little bit, but it's about $1,000, $500, $1,500. It's not much. And then once you live beyond age 80, especially for this person, you can see the benefit of waiting, how much their cumulative lifetime benefits are, and compare that to where if they started at age 62. So if they lived to age 100, I think most folks on today's webinar probably aren't expecting to live to age 100, but had they lived to age 100, there is almost, just over $250,000 of difference that's received over their lifetime by waiting to age 70 versus claiming at age 62. If they live to 95, that number goes down to about 190,000. And again, it's an unknown. If we knew the date of death, we could tell you exactly the correct Social Security strategy. But since we don't know, we have to make some decisions when you become eligible. And again, once you're eligible at age 62, you can decide to turn it on any month after that. You don't have to wait to your birthday. You don't have to wait to the first of the year. It's a decision that can be made any month. Let's talk about pensions briefly. Some folks do still have access to them. If you do see yourself forced in retirement, it's just let's understand the eligibility options. And again, maybe there was a severance and some increased benefits for your pension as part of that. But then too, do you have access to a monthly pension or a lump sum, or maybe both, or either or? It's typically, common for us to see someone who has either a monthly pension or a lump sum. But if it is monthly only, then what decision do you have related to taking a single life pension versus a joint life pension? Is Social Security part of the calculation? Again, sometimes they are, where when you're eligible for Social Security, your pension goes down, or they give you an increase if you retire early prior to Social Security beginning, give you a little bump, and then when Social Security starts, it reduces. If you do take a lump sum, if that's access, an option for you, typically that money would be rolled into an IRA, a traditional IRA, pre-tax IRA. But if you decided to receive some of that pension, that would be taxed as ordinary income. So you got to be aware of that. And typically these pension choices, there is no do-overs. Once you decide, you are kind of stuck with that decision. Similar to Social Security. Social Security has some small payback window if you do decide to change your mind, but again, it's pretty much locked in once you make that decision. The debt too is a common concern for folks, whether you're faced with a forced retirement or you just want to retire outright. A lot of people would prefer to have no debt, which nothing wrong with that whatsoever. But what we want people to do, especially in this forced retirement situation, but in any situation when you're thinking about retirement, it's just like, let's list out debt levels, what the payments are and what the interest rates are. Is it mortgaged? Is it a fixed mortgage, or is it an adjustable mortgage? Is some of it consumer debt that has maybe some higher interest rates associated with it? Again, what kind of debt is it? How much is the amount? What are the payments? And again, what are the interest rates? And don't just go paying something off, because there could be some good decisions related to an effective way to pay off debt. Or, hey, the interest rates are great. We would suggest that you should hold on to that debt and just make the payments. Because, early in this forced retirement situation, the priority is keeping your savings intact. We want to start there first before we make any big decisions. And this couple, they have, as I mentioned, they've got between their IRA and 401k, so their pre-tax retirement accounts $1.5 million. They need $120,000 net of taxes for the year, and that includes their mortgage payment. And their payment is currently $1,500 or just over that, and that's just principal and interest on a $300,000 mortgage. They have a great rate. They were able to refinance during 2020, 2021 in that range and get a great rate. But if they were to pull all that money out of their pre-tax IRA, it would cost them almost $287,000 in federal and state taxes. Now that would also include having their income need come out of the account as well. But it would be almost double the amount of the mortgage balance in terms of taxes to pay that off. You know, in my previous example, I showed, well, if they're taking all of their income needs out of the IRA, they would need $140,000 to clear $120,000. If they want to pay off their mortgage, their taxable income for that year would be $587,000. Just, you know, a big chunk, and that would reduce their savings by 39%. I mean, that'd be a big hit to their balance. But the payment, if you look at the annual payment, it only represents 1.2% of the balance. And because the rate was so good, and in us speaking with this client, we kind of recommended that they don't pay it off, and they chose not to. And we can address that year by year, especially as the balance comes down or as interest rates change. Does it make sense to just pay it off now or refinance? What are the options? And again, it's an annual conversation, an ongoing conversation, and decisions can be made in the future that are different than the decision that we decide on today. The other thing that you're going to be faced with is, okay, I'm forced in this retirement, you know, again, whether it's a health reason or my employer decides for me that, you know, that they no longer need me or my role at the firm, and I'm now, you know, faced with this. Now you have, if you've got access, if you've saved in your retirement plan, what do I do with this money? You know, can I leave it in there, or am I forced to roll some of it out, or how do I get access to it? What kind of after-tax accounts do I have, and how is that invested? What about other assets, maybe less liquid assets like real estate or farmland? And review the mix too of how it's invested. You know, it's common to see an increase in layoffs during economic contractions. You know, the economy's currently in a situation where it's expanding, but doesn't always expand. We have contractions from time to time. And, you know, again, it's common to see corporations lay people off during these economic contractions. And that's typically coincides with a decrease in the value of the stock market. Interest rates might go down as well during that period. You know, we look at correlations a lot between stocks and bonds and what's happening. And, you know, in these economic contractions, it's common for, you know, stocks to go down in value temporarily, and bond interest rates to go down as well. But what's that mix? And if you're needing to pull distributions out of your accounts, are you too aggressive? Do you have too much in stocks, and now you're faced with, hey, I need to start pulling money out, but it's also down in value? You know, the key is to always be reviewing this, especially as you get closer and closer to retirement, to make sure your allocation is correct, considering when you're going to need distributions from those accounts. The other thing on your less liquid properties, if you do have, you know, assets that are less liquid, what is the potential income from that? Or, you know, if I did have to convert that to cash, how, you know, quickly could I do that if that was necessary? As I mentioned, you know, these downturns are, it's really important because it can be very stressful. Again, you're forced into this situation. Again, health reason, employer makes that decision for you, and your investments are down in value because of an economic contraction. And, you know, it can be very emotional to, you know, have to deal with all of this. So that's why it's important for you to sit down with a professional that's been through this before, can walk you through exactly what you need to do and how to make sure that, you know, a mistake is not made that can't be fixed either. Sometimes these mistakes, there's no fixing them. And on the investment side too, deciding to change all the investments at a bad time, and then markets go back up in value, and all of a sudden you've locked in the loss when you sell everything. If it's down temporarily and you don't sell anything and it goes back up, well, then you haven't locked in any losses. It's a temporary decline. You know, these declines, especially when you're diversified, they're temporary. They're not permanent. It's permanent when you make a decision to sell the investment. That makes it permanent at that point. Now, how do we take the distributions out uh, from a tax standpoint? So there's different types of retirement plans that are out there. Most common that we see are 401ks, but there's also 403bs and 457 plans. There's more than that, but those again are the most common out of all of them, with the 401k being the majority of what people have access to. But 457 plans typically for state and local governments. And if you have a 457 plan, one thing to be aware of is there is no early withdrawal penalty. So as I mentioned earlier, when you're taking distributions out of retirement accounts, there can be rules around how much you can take out or what the penalties are if you choose to take a distribution prior to age 59 and a half. And there's ways to get money out and avoid that penalty. You still would pay income tax, but you would avoid the additional 10% penalty for early withdrawals. And a couple of those rules that we'll walk through is what's called the rule of 55, and also another rule that we call 72T, which is the name of the tax code is has a 72T in it. So that's the common phrase that's used. So starting with the rule of 55. So what this is, if you separate from service anytime, on your 55th birthday or later, that's the key. You can't separate from service at age 54 and just leave the money there and then take distributions after age 55. You have to be 55 or older when you separate from service. If you leave the money in the retirement plan, so you leave it in your 401k, you can take a distribution out of the 401k. There's typically rules around each 401k on the frequency of the distributions and the minimum tax withholdings. Some are more flexible than others. Each plan document would define what that is. And we're familiar with a lot of the companies in town and how they work with, but we can also any type of plan document we review and understand what the rules and regulations are for that specific plan. But you can take a distribution. You have to pay income tax on the withdrawal, but you're exempt from the 10% penalty. And that only applies to the 401k or, the retirement plan. It does not apply to an IRA. So again, you separate from service, if you leave the money in the 401k and you're over age 55, you have access to this strategy. If you separate from service and then you roll the money to an IRA, well, then this strategy goes away at that time. Now, 72T. Now, let's say you did roll money to an IRA or it made sense for you. You might have had company stock in there for a privately held company, and one of the only ways or options you had was to roll it to an IRA. That definitely happens. Or you're under age 55. Well, how do you get the money out at that point without paying the 10% penalty? So this 72T is the strategy that is used to avoid that penalty. And you can begin those 72T distributions at any time. So there's no minimum age requirement for that. But the rules, it's not very flexible. Now there's ways to structure it to provide some flexibility or optionality that I'll show you here over the next few slides. But the rules are, you have to continue those distributions for at least 5 years or age 59 and a half, whichever is longer. So if you're age 50 and you execute a 72T strategy, you have to operate this strategy up until your age 59 and a half. If you're age 58 and you execute a 72T to avoid the early withdrawal penalty, you have to maintain it for at least 5 years. So up until age 63. So it's whichever is longer. And there's calculators online. that you can find. We have calculators. We walk people through this. This is something that that we're very familiar with. But the payments must be the same every single year. And it's again, it's a calculator based on the federal midterm rate, that which changes every month. So there's kind of some nuance to it. But the way the rules work is you can separate your IRAs. So let's, again, I'm going to walk you through an example on how to think through this. But the payments 72T can just be executed on one IRA, and you might have 2 or 3 IRAs. But this one IRA is subject to this 72T payment schedule that, again, the same amount has to come out every single year up until age 59 and a half or 5 years, whichever is longer. And if you modify the distributions out of that account, then you're subject to a 10% penalty on all payments that have been taken prior to age 59 and a half. So it's not just the payments in that year, it's anything that's been taken from that point is subject to the early withdrawal penalty of 10%. So here's my example. We have Sue, she's age 54. She has 1.1 million in her IRA, and she's going to work part-time. She's going to work $48,000. She's going to earn $48,000 a year, and she needs an additional $24,000 a year from her retirement account to supplement her income. So here's what we're going to do. We're going to back into how much does she have to have in one IRA to generate the $24,000, from the formula. We can invest the money any way we want, and it's just the distribution amount can't be more than whatever the 72T calculator tells us for the month that they begin distributions based on the current federal midterm rate. So and it's based on your age as well. Well, the way that the current rates are at, and with the calculator, she would need 400,000, roughly, it's a little less than that, in an IRA to then, for 72T to work, to say she could pull out $24,000 a year based on, the current calculation. So what we would do is we would take $400,000, we would invest it for her, knowing that she's going to be taking $24,000 a year out of this account, and put it in an IRA. That'd be IRA number 1. Well, that leaves $700,000 that we would have in IRA number 2. And again, that can be invested for based on her situation, if she needs access to this in the future or not, however that's going to look for Sue. But that second IRA, the key is it's not subject to the restrictions that the IRA number 1 is subject to, that is utilizing the 72T strategy. So if she needed extra money one year, let's say she had to replace a car, she had a unexpected expense, whatever it is, she can take a distribution from IRA number 2 that has $700,000 in it. It would be subject to ordinary income and penalty. It would be subject to that, but it wouldn't interfere with her first 72T schedule. It wouldn't, create a problem on that account. The other option she could have is she could establish another 72T schedule at any point in the future and separate. If, let's say she wanted $12,000, well, we'd back into how much she would need into an IRA number 2 for 72T, second 72T, because you can have multiple 72Ts running, and then set up another IRA number 3 that would be available for emergencies, or, once she reaches age 59 and a half, if she was starting this strategy prior to, the 5-year schedule being exhausted. So that's how we utilize 72T. And again, I know there's a lot to this. It's can be complicated, but we're familiar with how these strategies work, and we can walk you through exactly what makes sense for you given your situation in based on what you're faced with. Now, tax planning is another key part to this because, as I mentioned, these examples that I've been using, we're doing a lot of tax calculations, and the big thing is, okay, well, how much money do you need after taxes? And you need a tax plan to figure out, okay, well, what's my tax situation today? What do we think it's going to look like in the future? Again, no one knows what it's going to be in the future, but we can create some estimates and definitely scenarios from a lifetime perspective of what your tax picture could look like, and then we can come up with a strategy, and that strategy can evolve year by year because tax policy changes. When Congress changes and when presidents change, typically tax policy can have some tweaks to it. Sometimes they're big overhauls, other times they're minor tweaks. But one thing we do know is it does change over time. And one of the current things that we see that's commonly missed is that, especially when people are in lower income tax brackets, they miss favorable treatment of long-term capital gains and qualified dividends. Well, what does that mean? If you're married and if you're in the lowest two brackets, a portion of long-term capital gains or qualified dividends may be taxed at zero at the federal level. You might have to pay capital gains tax at the state level or dividend tax at the capital gain level, but not at the federal level. And also Roth conversions. The example I used for the healthcare subsidy, that $30,000 Roth conversion would be at maybe a 0% tax or an extremely low, tax liability for them, given their annual income for that year. The amount that I mentioned on qualified dividends and long-term capital gains, married couple filing jointly. If they have taxable income less than $96,700, they would pay 0% tax on that. So here's an example. We have Bob and Jane. They need $100,000 from their investments over the next year, and they have two choices. They can withdraw the money from their IRA, it would be taxed as ordinary income, traditional IRA, but they also have an after-tax account. So it's money they've already paid taxes on, but they've invested it, and they would have to sell something, and they'd have $100,000 in long-term capital gains. So let's look at the tax liability based on, and they don't have any other income. So it'd either be $100,000 IRA distribution or $100,000 long-term capital gain. If they take it out of the IRA, the federal and state tax, they live in Kansas, so I use the Kansas tax code, and this is for 2025, would be roughly, the combined tax liability would be roughly $11,800. If they just sold the investment and generated $100,000 in long-term capital gains, they'd pay zero federal tax and have $3,900 in state tax. So you can see the difference in tax liability based on the source of the income in retirement. I talked about Roth conversions earlier too. You move money out of your IRA into your Roth IRA, and that taxable, that amount is treated as ordinary income. So it's whatever tax bracket you're in. As I mentioned, that first example in the healthcare subsidy, they're in a very low tax bracket. Now, if their income was significantly higher, Roth conversion may not make sense. If Jill converts $100,000 from her IRA to a Roth, it'd be added to her income. That's just how that works. And how do you think about that? This is we have lots of tools and calculators that we utilize to evaluate how much someone should convert to a Roth IRA, what impact does it have on their current tax situation and our projected future tax situation for them. If they're eligible for Medicare, does this increase their Medicare premiums? Medicare will charge more to those that have more income. Again, check out our Social Security and Medicare webinars for more details on that. But if one of the just easiest ways to think about it is, well, should I at least fill up the rest of the current bracket that I'm in and convert that money to a Roth IRA? So, for example, they're in the middle of the 22% bracket, this married couple. Maybe they just get to the top of the 22% bracket and convert the excess amount up to the top of that bracket to the Roth IRA. You know, the way we would look at that is, well, are they going to be in the 22% bracket, assuming the 22% bracket stays for, you know, long periods of time? May go higher, but if they're going to be in this bracket for the foreseeable future, then yes, it could make sense. Now, if their taxable income is going to be less in the future, then no, it may not make sense, because you'd be paying more tax today and less tax in the future. So, you know, again, we've got to do some analysis on everyone's individual tax situation today, and again, projected into the future. Yeah, low income years, you know, great for Roth conversions. You know, even business owners too, if they have a bad year, low sales, or they have you know, a lot of expenses one year and their business income is low or negative, you know, you could actually offset a negative amount on your business income with a, you know, Roth conversion. If you have high non-reoccurring medical bills, so you have a big medical expense in one year, you're able to deduct a portion of your medical expenses over a certain dollar amount. And for many folks, that typically is not common to deduct that from your income tax. But if you have a very large medical expense in one year, then you know, you might be in a low bracket where a Roth conversion would make sense. And definitely we evaluate it prior to turning on Social Security, because that counts as income. You know, benefit pensions starting, RMDs starting at age 73. You know, these are all different factors that come into if or when you should convert money to a Roth IRA. Well, I know, you know, we covered a lot on today's webinar, and I appreciate all of you joining here today. But yeah, one of the key things, you're forced into an early retirement for any reason. Well, key number one, you know, don't panic. You know, we want to avoid knee-jerk decisions. So it's, yeah, don't be in a rush to pay off that mortgage or make any investment decisions, especially if we're going through a pullback in the markets. You know, that could be, again, very stressful for a lot of folks. But put together a financial statement. Start with your assets and liabilities. Get an idea of what your net worth is. What's liquid? What's less liquid? What do I have access to if I'm younger and don't have any penalties? How, on my less liquid investments, how quickly can I convert them to cash if I had to? What are my health insurance choices? Am I eligible for Medicare? Do I have to stay on COBRA? Are the exchanges an option? If you're close to Social Security or eligible for Social Security, what choices are you faced with that? You know, review the allocation, just understand how your investments are structured, but again, avoid any knee-jerk decisions related to that. And if you can, I mean, starting the planning process sooner than later is very important, because for the clients that we've been working with, and we've been putting plans together, and then all of a sudden this situation happens. You know, we're typically one of the first people they call, and we walk through, okay, let's talk through it. Our original plan was this, retirement at a certain age and all these other assumptions. Well, now you're forced into an earlier retirement. Can you just say, hey, I'm done, I've got enough, I don't need to worry about finding another job? But what are your individual Social Security choices, health insurance choices? You know, how am I going to generate income? When you have a plan put together ahead of time, then this becomes a lot less stressful of a situation, because there's a plan in place. You're not starting from scratch and having to deal with all this stuff at the same time. Well, check out our website, keenwealthadvisors.com, the retirement resources page. You can find previous webinar replays, blogs, podcasts, all of the above. If you'd like a copy of Mr. Keen's book, please, send us a note, send me a note, mwilson@keenwealthadvisors.com. We'll send a copy out to you. And our YouTube channel, you can find us, youtube.com/KeenWealthAdvisors. Lots of great content. Again, these webinar replays are there. A video version of our podcast is there. A lot of great things. So again, thank you all for joining us today, and looking forward to speaking with you all again next month.